Hey there, people. How are ya? Hope you're doing great as always. Welcome to the Financial Fortress. And today we are talking Palantir, ticker symbol PLTR. And they just got slaughtered after the earnings. But there is quite a bright future for the company, in my humble opinion. And that's why I basically put on my turtleneck today. So you understand that this is going to be a video for investing nerds. I will be going through my valuation model, which I basically updated today after the earnings. And I will be going through bear, base, and bull scenarios that might play out over the coming 5 years. So let's get into it. And spoiler alert, in both three cases, you will be making money. And before we go into each of the three individual models, let's talk about valuations in general for a little bit, right? Because there are definitely a couple different ways how you can value a company. In a typical Wall Street fashion, you would probably do like a discounted cash flow model, which I found definitely useful. However, discounted cash flow kind of gives you, in a sense, like a current possible price of the stock, right? So you might see that a certain company is undervalued or overvalued based on basically the exact metrics available today. But in that model, it's a little harder to kind of extrapolate what the possible price target might be further down the road, right? If you are kind of looking 3-5 years out, which I always try to do. So basically, the way I do the valuation is kind of extrapolate the potential revenue and net income over a longer period of time, and then basically estimate what the potential PE ratio might be, and some of those different metrics, and try to find basically what might be possible given kind of their peers and comparison with other companies, and in a sense try to find a lowest possible valuation that at some point, if you would just go down to those P metrics, it would just get ridiculous, right? Imagine that, for example, Apple at this point was trading at like 10 PE, right? With all that amazing stuff they are doing. It would be ridiculous, wouldn't it? And in the same way, I basically look at my own valuation models, and they were also inspired basically by Katie Wood when I started investing in Tesla in 2018, 2019. I basically went through her valuation model, which obviously was super complex, and the way I'm doing it is like super dumbed down version of it. But you also want to have different kind of scenarios that might play out, right? If you're extrapolating farther out in the future. So that's why you are basically doing like the bear, base, and bull case scenario, because of course it depends on the execution, right? So there is a certain probability that bear case plays out, certain probability that the base case plays out, and certain probability that the bull case plays out. And in an ideal case, you want all of these three models be positive for you, right? You are making money even in the bear case scenario. And hopefully there are some positive catalysts that might play out, which will basically power up your bull case. So let's take a look into the Excel spreadsheet and the details. So if you are investing nerd, stay with me. So let's start with the bear case, shall we? Basically, I'm basing these numbers on the management team's numbers. And what we kind of found out, and at this point everybody kind of caught on their lie, is that they're expecting a 30% annual growth all the way to 2025, right? But that doesn't seem to be the case, because in the fiscal year 2021, these numbers are basically just updated from the presentation. They did 41% growth. But let's just assume that they are going to do those 30%. 30% in 22, 23, 24, and then a little bit slowing down, 25, 25, 25 for the next 3 years. So basically my estimation runs all the way to 27. So basically 5/6 years from now. And let's assume that they are just kind of maintaining this 80% to 78% gross profit margin, which seems to be the case, meaning that this would be the cost of revenue. And then the operating expenses kind of growing at a steady pace because they can. And obviously the stock-based compensation is kind of something that's on lots of people's mind. Because obviously they diluted shareholders heavily right after the DPO. But from this point on, basically Alex Karp said that the share dilution should be in line with other peers, that, you know, because obviously all of the tech companies are doing it, and it's the way to maintain this top talent. Obviously, you know, Facebook is doing it, Google is doing it, Apple is doing it. It's pretty much the standard procedure. Just it's you know, you are being diluted as a shareholder by certain percentage. So for the sake of the argument, I went with 4%, which would be on definitely the higher side, right? And based on these numbers, we are getting somewhere to like $1 per share by 2027. And so if we slap a P ratio of 30 on that, we are getting a share price of somewhere around $29. So approximately 18% CAGR. So, you know, decent, right? I mean, 18% CAGR, you should be pretty much in love with if you can find a company in that area, right? So this is the bear case. Let's see what the base case could be. For the base case, we are starting with the revenue growth as well, because that's one of the metrics that basically influences the model greatly, right? If you are growing, you know, annual compounded rate of 30% or 40% or 50%, these are huge differences. So for the base case, we are basically saying that for 22, Palantir is going to deliver the same as for the 21. And after that, it starts to slow down a little bit to 35, 35, 35, and 30, right? Cost of revenue, again, kind of in line with the gross profit margin. I think that's like super reasonable to say that there is really nothing that will disrupt the profit margin there. You know, Palantir as basically a SaaS company, or more on the SaaS side, especially going the direction. They were pretty steady about this number from their presentation, so I just want to maintain that. And similar for operating expenses, I've modeled them as, you know, kind of the growing, because basically if you kind of compare it with quote unquote peers, you know, like lots of people are comparing it to either Snowflake or Datadog, you can see that Palantir's operating expenses are actually pretty steady, or, you know, they are a little bit like flimsy, you know, some years a little bit or some quarters a little bit higher, some quarters a little bit lower, but they're not growing much. But just for the sake of argument, I modeled them as slightly growing compared to both Snowflake and Datadog, where operating expenses are kind of growing in a similar pace as the revenue, which is a little bit alarming, and kind of the reason why I'm very bullish on Palantir compared to the other two, because it just seems that the other two need to spend much more money in order to grow their revenue. But let's back to the base model, right? So the other thing that I've changed is also the share dilution, where I've put it a little down to 3%, which should be pretty reasonable numbers to still maintain the top talent. Again, kind of in line with peers, I would say, and slapping the P ratio of 35 at the end of my projection model, which could lead to a share price of $74, meaning 6-year CAGR of 37%, which I think that's quite insane, right? You know, that's basically, you know, especially now that Palantir, you know, after those earnings got slashed to like 11, 12, that basically mean that there is a possibility, if the macroeconomic conditions are kind of still favorable, because obviously there are so many different aspects that might influence the stock price. But basically under the current environment with that particular PE, we might see a Palantir being like 180 billion company, and I would say that's relatively reasonable to say. So that's the base case, basically kind of showing what's possible if Palantir is maintaining the traction it has in 21. But there is a possibility they will do even better than this. Let's take a look. If they execute well and really click on all four cylinders. And basically this scenario is based on the fact that the numbers you've seen from 2021 are still based on their old doctrine. The doctrine of our product is so much better than everyone else's, meaning we do not need no sales team. And as we've seen, that wasn't really working that well, because obviously Palantir and their products, Apollo, Foundry, Gotham, are so complex, and potential customers just need to be explained how it can improve their operations and everything. So until Palantir and their software gets more embedded into the fabric of modern enterprises, that sales team is, in my opinion, necessary, right? And we will, in my opinion, we will see the results of this sales team only in maybe like second half of 22, because basically most of the sales staff was hired in the end of 21, and they still need to get running, because Palantir and their software, it has very long sales process, right? It might take, at least couple months, maybe half a year to really establish that relationship with potential customers, at least in the beginning, before they really scale downstream into like smaller enterprises and get more well known. So they are really just in that startup mode at the moment and trying to basically, spread their tentacles all over the world. So what the scenario I might see playing out is that we will actually see a slight acceleration of growth in maybe already second half of 22 or 23, 24, where basically that sales team will bring results, will basically boost the results, right? So if we are seeing a scenario where Palantir might grow 40% this year and maybe accelerate to 45 for the next 2 years and then slightly slow again, their numbers will obviously get significantly better, with, again, gross margins kind of staying the same, similar with the operating expenses, and let's say the share dilution gets even slightly smaller, maybe down to 2%, because obviously if you are also doing well, right, and you are basically compensating your employees in stock where the price kind of appreciates, that can mean that you don't need to dilute existing shareholders so much. And of course, if this scenario plays out, that also means that the company might deserve much more higher P ratio, right? So if we slap a P ratio of 40 on this might be all the way to 116 US dollars, in my opinion. Meaning that Palantir will basically be over $250 billion by the end of 27, which I would say it's definitely not unreasonable. However, again, everything depends on execution, right? Especially if you are having such a long-term horizon, because that's what really drives the stock price in the long run. The execution, right? Because everyone can say that they will have 30-35% compounded annual growth rate over 5 years, make a nice presentation deck with a nice fonts, make a nice conference calls, but in the end it comes down to execution. So 116, I think that's possible. So let's see how these scenarios play out, and let me know in the comments which of these 3 scenarios do you think is the most probable. So comment down below. And of course, if you enjoyed my valuation and if you would like to see more, smash that like button, heart button, whatever buttons there are. Tell your neighbors, potentially your girlfriend if you have some, or your boyfriend, whichever you prefer. Thank you and take care.